Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. India's banking and financial sector continues to be loaded with giant NPAs and they continue to mount. The problem has not been resolved, the problem has not been mitigated, and because of that, India today faces the worst NPA crisis in the world as compared with the G20 nations and also as compared with any other major comparable global economy. This precarious position is reflected in the shaky banks, NBFCs, and financial institutions of India. And this problem of bad loans, this problem of rotten loans, is not just restricted to public sector. It also manifests in the private sector in a big way, and the entire sector remains suspect. Let's look at the present saga of rotten banks and financial institutions that have surfaced so far in India. 14 public sector banks had to be put in prompt corrective action sometime in 2016-17 by the RBI. These banks were bankrupt, and what was the result of it? In the last 3 years, the government of India has had to pump in over 3 lakh crores in order to recapitalize these banks which were otherwise bankrupt. The next one that exploded on the scene was ILFS sometime in September 2018. ILFS involved about 1,40,000 crores of public money and it went belly up. Then came the PMC Bank. The PMC Bank crisis was puny and small compared with ILFS, just about 15,000 crores of depositor money. But then it went bankrupt. It has not been resolved so far. Then came Diwan Housing Finance. About 90,000 crore of bank loans are stuck in the company, plus another huge amount of money of depositors. The company has been referred to the NCLT for resolution, but it is just yet another bankrupt financial entity. Then we had Yes Bank. Over 2 lakh crores of public deposit involved in the bank, and it had to be rescued by the RBI by a hurried plan in which SBI pumped in about 10,000 crores. We've had the case of India Bulls. We really don't know what the story is, but India Bulls also remains a suspect entity. And now the latest in this saga is the Lakshmi Vilas Bank, a bankrupt entity which had to be rescued by the Reserve Bank of India. In this entire chain of institutions that failed, some got bailed out, some did not. There has been no standard policy that we see which is followed by the Reserve Bank as a template. Perhaps politics prevails in these bailout decisions also. And that has been best evident in the case of the PMC Bank, wherein the bank has not been bailed out so far and about 15,000 crore of depositor money is at risk. The bank has been in doldrums. It is closed at the moment. Let's talk about this latest rescue by the Reserve Bank of the Lakshmi Vilas Bank. The Lakshmi Vilas Bank has witnessed a very swift and timely action by the Reserve Bank of India in order to restore and maintain system stability and reinforce confidence of depositors in the entire banking and financial system. Let's talk about it. The Lakshmi Vilas Bank is a 94-year-old bank headquartered out of Karur in Tamil Nadu. It has a strong presence in South India and also a pan-India presence. It has 563 branches, 974 ATM installations, and also a large number of POS for merchant sales through credit and debit cards. It certainly has had a good customer base because of its long history of almost a century. And today, after deposits having been withdrawn, it still has over 20,000 crores of deposits, and against that, it has given loans and advances to the tune of 17,000 crores. The bank has been in a serious financial trouble for the last 3 years. It has been struggling to survive. The bank has been in a serious financial position primarily because of reckless lending that took place during the period financial years 2014 to 2018. During that period, the bank expanded its loan position book at an extremely fast and reckless pace. It indulged in risky, big-ticket corporate lending, particularly to corporates which were of a bad pedigree. It also lent copiously during this period to sectors of the economy which are rated as high risk. For example, Lakshmi Vilas Bank has an exposure of 900 crores to a company like Religare, and it is certainly going to struggle to recover that money. This kind of lending by the bank resulted in a rotten financial position such that while its NPAs were about 2.7% of its loans and advances in 2017, they shot up to 17.3% as of 31st March 2019, and as of 31st March 2020, over a quarter of the loans and advances have been classified as NPAs. That is the kind of bad lending, reckless lending that the bank indulged in. Because of that, today its net worth is fully eroded. It has a negative capital base. Its losses on account of NPAs in particular are mounting. Its deposits have been vanishing. There has been a run of sorts on the deposits, resulting in a sharp fall in deposits. Its advances have been depleting, and there are also huge governance issues in the bank. In the AGM of the bank held on 25th September, the shareholders voted out the 7 directors, and they even voted out its managing director and CEO. They also refused to reappoint the statutory auditors and branch auditors of the bank, showing complete lack of confidence and trust in the entire management setup of the bank. Today, the bank is thus struggling to survive. Its losses have been mounting. In the financial year ended 31st March 2020, it showed incurred losses of 836 crores. In the quarter ended June 2020, another 112 crores of losses were recorded. And then in the September quarter, they mounted further to 397 crores for the quarter, such that today, as compared with its assets, it has a negative net worth of 4.8% as of now. The bank certainly needed capital to be raised on a very urgent and desperate basis in order to survive. And for that, its plan was some kind of a merger. In April 2019, the bank announced a merger with India Bulls. The Reserve Bank rejected this proposal. And the reason it rejected it was that the proposed merger with India Bulls Housing Finance had a very lopsided exposure to the housing sector, which was not acceptable to the regulator. After rejecting it, the Reserve Bank of India put the bank under a PCA regime in order to ensure that further deterioration does not take place. Then the efforts continued. In June 2020, the bank announced a proposed merger with Clicks Capital, but even that was rejected by the RBI on account of issues to do with the loan exposure of the two entities. After the Reserve Bank rejected the Clicks proposal for merger, it on its own started hunting for a suitor. It started hunting for another bank in order to bail out the Lakshmi Vilas bank. And for that, the Reserve Bank then approached the DBS, which is the India subsidiary of DBS Bank Singapore. The Reserve Bank, of course, got in a hurry to bail out the bank, not just because of the precarious financial position that the bank had, but also because of the huge governance issues. It had appointed a committee of 3 directors to look after the bank, but that was a temporary measure. While on the side, the RBI kept hunting for yet another suitor to take over the bank. What is the present position now? The present position is that the government has put the Lakshmi Vilas Bank into moratorium until the 16th of December. Till then, nobody can withdraw beyond 25,000 rupees, and any excess withdrawal, if any, will be permitted for issues like medical emergencies, marriages, etc. So till 16th of December, the bank remains in moratorium. In the meanwhile, the Reserve Bank has proposed its merger with DBS India, and for that, DBS India is proposing to infuse about 2,500 crores of additional capital in the bank after its takeover. All action against Lakshmi Vilas Bank in this period, all proceedings against the bank will stop, and even its day-to-day activity has been halted until the merger is approved. And the RBI is considering the merger proposal, and it will approve it only after it takes into account the interests of all the other stakeholders, which is primarily the depositors and other creditors of the bank. In the meanwhile, Lakshmi Vilas Bank has been asked to honor all its commitments in the money market to ensure stability of the money market and any other prior financial commitment that it might have made. The Reserve Bank continues to look into the merger, and the primary issue that is now surfacing in it is that as part of the merger, the bank proposes to write off the entire paid up capital of Lakshmi Vilas Bank. In other words, the present shareholders of Lakshmi Vilas Bank will be left without anything in their hands, and that is going to become a bone of contention. It's a matter under consideration by the Reserve Bank of India. So what would happen? Once the bank merger is approved, DBS would take it over. It would infuse 2,500 crores of additional capital. The existing capital of the shareholders of Lakshmi Vilas Bank would be extinguished, and down the line, Lakshmi Vilas Bank will lose its entity. After all, it is being merged with the DBS. It is said that for 2 years, the bank's name would be DBS LVB. After that, the bank, the 94-year-old bank, will lose its independent existence. What are the larger issues that emerge from this saga of rescue of the Lakshmi Vilas Bank? The first one, of course, is that the Reserve Bank has truly moved in very swiftly in order to protect depositor interests, in order to maintain stability of the system. The RBI had to do that because of the precarious financial position of the bank, because it saw that the present management is not able to get an investor to rescue it, and because it also saw that the present management had no viable strategy. The RBI thus gets kudos for rescuing the bank on time. Because of that, the bank is safe, the depositors are safe, and it will be able to continue its business further. DBS comes with a good parentage, it comes with a good pedigree, and it always wanted to expand its footprint into India. For it, it's a ready-made bank that is now there with 563 branches and a pan-India presence. And this example could probably encourage many other foreign banks who are keen to enter India and get a ready footprint to absorb, to get into, to invest, to bail out, or to merge with sick banks or sick NBFCs in the country. We think this could be a precursor, a good example to get more foreign investment into banks, into the financial sector in India. Of course, the unions of the bank are not happy. They were expecting its merger with a public sector bank like the PNB. But then, if that was done, it would not have been a good decision. We needed a strong financial partner, and PNB is in no shape to do that. The shareholders of the bank are certainly irate and angry. They are losing their entire investment in the bank. The Reserve Bank will have to take a more considerate stand on it. And the most important issue, according to us, is these kind of instances are going to continue. The NPA crisis has not been resolved. The system continues to be loaded with NPAs which are rising, and you might have more instances of banks and NBFCs failing. What we need is a standard template. What we need is a standard policy. What we need is a standard operating procedure by which the Reserve Bank ensures bailout of banks or merger of banks. There cannot be a situation where the PMC bank gets a stepmotherly treatment, while others like Lakshmi Vilas Bank and Yes Bank get such a treatment that depositor interest is completely protected as against the PMC depositors who are lying hanging in the lurch. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.
If you like this video, please share it, and we would love to hear your comments in the comments section down here. Also, please do like our Facebook page and follow us on Twitter to get minute-to-minute news updates. For more such shows and videos, well, subscribe to our YouTube channel.